Hey everybody, welcome. My name is Maria Pearman, and I'm so excited to be here with you for the CBC Forum. I'm going to be talking about 5 keys to a strong financial core. A little bit about my background and why I'm talking to you about finance. I am a CPA. I'm based in Portland, Oregon at a firm called Perkins and Company, and I specialize in beverage alcohol finance. I've been focused in this area for about 12 years and wrote a book on small brewery finance last year for the BA. And I just love the industry. I really am passionate about helping the folks who are business owners in the area kind of take away burdens and take away blockers to their success and give them room to do what they do best. And a lot of times the people who run businesses in beverage alcohol are really passionate about their product, but maybe not so passionate about the debits and credits. So I like to be able to provide that support there, and also to, educate people as to some of the fundamentals of finance so that they can run a better business. And that's what we're going to talk about today, financial fitness. Financial fitness is like physical fitness for your body. You want to be strong yet flexible, and core strength allows you to move efficiently and effectively. So if we use that same analogy as a base for our discussions, I'd like to present 5 keys to that, to developing that core, developing and preserving the core. And as with all forms of fitness, consistency is key. So to be financially fit, you need to consider a couple. I'm sorry, I'm trying to navigate through my slides. I kind of have to go back and forth here to get the slides right. So to be financially fit, whether it's personally, hang on. I gotta push the pause button, sorry. Okay, I think this is good. Whether you're talking about personal financial fitness or professional financial fitness, you need to be able to manage your money to work for you. Money is a tool that allows you to achieve your goals, and I really encourage everybody to kind of change the way they think about money and view it as a resource. And it's a resource there for you to make your dreams come true. So think of it as a tool that you manage instead of it managing you. And the first key to managing your financial fitness is commitment to monthly methodical review of finances. Peter Drucker said, if you can't measure it, you can't improve it. And that is 100% true. So it's so simple yet critical. So in terms of a monthly review, this should include a line-by-line review of balance sheet and income statement. So when I say income statement, that's synonymous with the term profit and loss. A lot of people call it your profit and loss statement, but it means the same thing, income statement or P&L. I think it's important to involve your leadership team and then also respect the balance sheet. So to go into that a little more in depth, I strongly recommend setting aside time to review with your leadership team. A well-functioning team has leaders who understand the performance of each division. So I recommend sending reports to your leadership team members at least 2 days in advance of your group meeting. With that, and usually this is going to be the CFO or whoever is wearing the CFO hat in your organization will be the person doing that. Provide a summary of performance when you give those reports. So there might be an email that goes out. It's got your financial reports as well as a high-level summary of the performance. It's going to include some key statistics and KPIs. Then also solicit questions from the leadership team. So the CFO should, encourage people to bring back their questions that they want answered during the group meeting. And again, like if you're sending the reports 2 business days in advance, maybe those questions are coming back to you 1 business day in advance, and then you've got your group meeting the next day, and you're going to address all of the questions that you got back from department heads, and then look together at the highlights. So in the group meeting, I don't necessarily feel that you need to go line by line, but that should be done independently. Each person should independently do that. So together as a group, you're going to be looking at the highlights of the month. So I want to dive into what I mean by a line-by-line review. And it is, again, so simple, but I really believe that if you take the time to set aside, say, an hour per month to look at each change month over month in every account, you need to ask yourself, do I understand what's in here? And do I understand why it's changed up or down? So this will help a business owner or a business leader stay close to the financial performance of the company, even if he or she is not doing all of the data entry. And it really is important because you're going to start to gain an intuitive sense of the movement of the business after you continue to do this review month over month for a period of time. A note about leadership teams. So what do I mean by that? Who should be on it? Leadership team, I strongly believe, should be the owner or CEO, and it should be the department head for every department. So if we're talking about a brewery and a tasting room, or a brewery and restaurant, you should have your CEO, your head of sales, your production director, head brewer, general manager for the tasting room. And also your CFO, if you have that. Whoever is wearing that accounting hat needs to be in there as well. So strongly encourage you to come together as a group. Everybody needs to understand where different departments are coming from and what their performance is and how they contribute to the whole of the business. And what I mean by respect the balance sheet is, the income statement is probably the most intuitive of all the financial statements, but the balance sheet is arguably more important. And the balance sheet is like sticking a thermometer in your business. It shows how leveraged a company is. It lays bare issues that could be covered up on the income statement. An example of that might be a company that is financing their operations with credit card debt. You're not going to see that on the income statement, but if you open up the balance sheet and see how the income and the balance sheet are playing together, it gives you a sense of the true health of the business. Also, the equity section includes retained earnings, and retained earnings is basically just all of the net incomes of the prior periods added up into one number. So it really does represent the balance sheet and the income statement together. I recommend leading your financial review, your monthly financial review, with the balance sheet, simply to drive home the point of its importance. You can showcase the KPIs that are critical, like your current ratio, debt to equity, and also day sales outstanding and AP days. I've got a slide about that in just a second, but I would strongly recommend leading with the balance sheet. So a sample agenda of a financial review might look something like this. You would have 4 reports that we would look at. So leading with the balance sheet, have your balance sheet as of the current period. So if this is October, we would look at the balance sheet on 9/30/20. And then you're going to have a separate column that has it versus last month and then the same period last year. So your columns would be 9/30/2020, 8/31/2020, 9/30/2019. And that is going to give you some landscape, some context for the financial health today versus other time points in your history. When you're in your balance sheet, I also recommend looking at some of your liquidity and solvency KPIs. And we'll take a look at those on a future slide, but liquidity refers to the ability of a company to pay its short-term obligations as they come due. Solvency speaks to a company's ability to pay its long-term debts. So the two are very similar yet different. And I think it's important to keep an eye on that, because another reason why I like the focus on the balance sheet is if you're an outside party, like a potential investor or a bank, they oftentimes are concerned about the health of the company, the wherewithal for the company to continue into the future. And so a lot of that external judgment is on numbers that reside on the balance sheet. The second report should be your income statement, also known as the P&L. So you will have your current month versus your budget versus the same period last year. So I really encourage you to use your budget as a management tool. And that is a topic that's a whole other ball of wax, but there are a million reasons why using a budget as a management tool can help a company, will lead a company to greater performance. But anyway, so you're going to have your current period. In this case, if we're looking at September, it'd be September 30 or September 2020 versus the budget for the same month versus September 2019. And again, giving you context for how close did we get to our budgeted desired results, and then how are we doing now versus where we were last year. And again, the idea as you go through this is not to necessarily form judgments about performance, but rather as you look through each of the accounts, understand why they went up or down. And then, pick out some things from there that you want to change for future periods, and use your review of the financial reports to inform how you want to change your business going forward. Another report that is incredibly important is the income statement by division versus budget. So income statement by division means your revenue centers. So in the example of having a brewery and a restaurant together, you would have one income statement for wholesale sales, one income statement for the restaurant. Those are two different business models, and it's important to judge each of their own merits. So it depends on which accounting system you're using, but some of the most common accounting systems are QuickBooks or Orchestrated Beer. So in QuickBooks, the most efficient way to set this up is by the use of classes. And in Orchestrated Beer with divisions, it's actually called divisions. So if you're an O-Beer user, this is your -01, -02 extensions of your account numbers. So by having those discretely stated, you can let the division heads understand their performance for a period in very real terms that are relevant for them, and not just as baked into a hole for the company that they can't really dial into and see what went well, what did not work. When you're on your income statement, I encourage you to do a review of profitability and efficiency KPIs. So profitability, you're going to look at things like gross margin. So gross margin being revenue minus COGS. Efficiency is going to be things like how fast are we using our inventory? Like how quickly does that turn into COGS? How fast are we collecting receivables? How long are we taking to pay our payables? So those are the types of KPIs that really can help you see how efficient your operations are, and can shine a light onto areas that might need to be shored up or could be improved. And then finally, one of the most important reports, I feel, is a review of profitability by Skew. And this really helps you see on a SKU by SKU level how your beer is doing. And the more that your business is driven off of wholesale, the more important this report becomes. So oftentimes we end up having very little visibility into which brands are making us money and which aren't. We could be selling the hell out of a brand and it really isn't contributing very much to the bottom line because of the ingredients in it, or because of the labor involved, or the time it takes to produce. So really getting clear visibility into that question is incredibly important. In addition to that, it can be very useful to look at this if you're coming up against constraints in terms of your production availability. Like if you're running out of space and you don't have much more capacity available, this is a great tool that helps you see, okay, which brands should I focus on? Perhaps there are like 5 brands that are, or 5 SKUs that are not performing, to the level that you would like. Maybe you just want to cut those out of your lineup and focus on the more profitable. So having that degree of insight into your numbers is going to help you make more better thought out managerial decisions. Okay, so the second key is keeping your debt in check. So managing debt is the second key to financial fitness. Most businesses have some level of debt, for sure. You might have debt because you're expanding or you're making changes to increase your efficiencies, but the key is to keep it at a healthy level. So, there's good debt, there's bad debt. Good debt has the potential to increase your income and therefore your net worth. Examples of this might be a mortgage if you're buying property, or it could be an SBA loan that has a really long-term and very favorable rates. And, debt that is allowing you to expand and perhaps buy tanks, which is going to help you sell more beer, which is going to contribute to the bottom line. Bad debt, on the other hand, is borrowing money to fund your working capital. And there's a big asterisk around this, which is, if you are in startup phase, obviously you're going to, unless you have very deep pockets from equity contributions, you're most likely going to borrow some money for working capital in those early days, and that's to be expected. But once a business is mature, it really should not be incurring credit card debt that's unsustainable. I'm not advocating for not using credit cards. I think credit cards can be very valuable, but you need to use them responsibly. It's the same type of advice that you would get on personal finance. Use your credit cards, but keep them in check. So if you find that you're supporting your business and just kind of keeping afloat, if you're incurring more debt just to keep the lights on, then that's telling you that there's something about your business model that's unsustainable. A healthy business model should be one in which there's enough net income flowing to the bottom line that allows you to cover your debt service. And debt service is the payment of debt principal and interest, and then also have money left over that you can start to incur savings or save for the next round of investment. So keeping your debt in check is a critical tenet of this. So what type of ratios should you measure in terms of debt, and how do you know if it's in the right place? So 3 that I like are the current ratio, the debt to equity ratio, and the debt service coverage. So current ratio measures liquidity, and here under each bullet point, the text that's in italics is the equation, how to calculate it. And then, next to the name of the ratio, I've given you the metric of what it should be in terms of numbers. So with your current ratio, you're looking at the relationship between the value of current assets and current liabilities. Ideally, you want this to be 1.5 or better. And sometimes this can be difficult to manage, but I strongly encourage you to shoot for having it at that 1.5 or better. And just a quick note, this is a little bit of an aside, but I think it's germane to the times that we're in today. If you have PPP funding or EIDL funding, that should be on your books as a non-current liability, because the cutoff is that current liabilities are things that are going to be due in the next 12 months. But for PPP and EIDL, there's such a long payback time that lives in the non-current liabilities because you're not going to have to pay it back within a year. So just a note. The debt to equity ratio is pretty simple calculation of how much do you owe versus how much have you built. It's a measure of skin in the game, if you will. So we want to keep the debt to equity at 1 or less in an ideal world. Again, it's, I kind of hesitate to give parameters around debt to equity because so many companies have very different capital structure. And what I mean by capital structure is when you start your business, are you doing it through bank loans, or are you doing it through money out of your own pocket or money out of investors' pockets? So, let's assume that a brewery takes $1.5 million to start. How much of that is money that you have to pay back versus money that you're putting on the line, skin in the game? So, to say it should be 1 or less is, I just want you to understand that could vary greatly depending on what your capital structure is. But all in all, once you're a healthy company and you're mature, I still stand by that being a pretty good metric of what's healthy, what's not. Debt service coverage. This is almost always used by banks to measure the health of companies that owe them money and to make sure that they're staying in line. A lot of times banks will require covenants on their debtors. So that means if you have a loan from a bank, you have to meet XYZ to stay in compliance with that loan. And those XYZs are metrics of your finances. And debt service coverage is one of the most common metrics measured. And most common is also 1.25 or better. Sometimes you're going to see 1.3. I've seen that as well. But I'd say by and large, 1.25 is kind of the norm. So the way you measure that, you're looking at your net operating income divided by your principal and interest of payments for debt service. And this means that you're making enough in net income to not only cover the debt that you owe, but then have a little bit on top of that as well. So those three metrics are really important to keep an eye on your debt service. And that also leads us into the third point of financial fitness, and that is positive cash flow. So by and large, cash flow should be positive. And again, there's a seasonality there. So acknowledging that, if we're in Q1 or Q2, things might not be as positive of a cash flow nature. But for the most part, you should have a cash flow positive business. Cash is the lifeblood of your business. And often for companies, it's more important to measure cash flow than it is measure profitability. I think a lot of companies get wrapped around the axle trying to engineer their decisions to have the best profitability outcome. However, sometimes that can have negative consequences for cash flow. For example, if you are trying to contract raw materials or get some type of efficiency, it can also come in the form of labor. Like if you end up hiring a position instead of outsourcing a position, you end up in a position where you could be letting cash flow diminish in lieu of profitability. So I think it's really important to understand the difference between profitability and cash flow. Let me go back a slide. So a word about positive cash flow. A company with positive cash flow has increasing liquid assets being cash or near cash assets. And when those are increasing, that means that you have more money to pay down debt, to reinvest in your business, return profits to shareholders, and provide a financial buffer. And it's important to understand the difference between cash flow and profitability. So cash flow is the change of cash within a period, and profitability is tied to accrual accounting. And profitability speaks to the economic reality of business regardless of cash effects. So what do I mean by economic reality, and why is that different than cash? It's things like timing differences on when you bill something versus when you get paid. And it's also concepts like depreciation. If you look at your income statement, you're going to have a line in there for depreciation expense, but that is just an economic expense. It's not a cash expense. So, that's a difference. And I've put together a little presentation that hopefully will make this clear, but you've got a scenario where we're going to assume 5 invoices are created each month. Let's say the average value is $2,000 per invoice. We've got net 21 terms, and COGS are 50% of revenue. And then we've got operating expenses that are $3,000 a month. So I've indicated here at the bottom right your profitability versus your cash flow. So just take a look at month 1 and 2. Everything is the same in terms of your revenues. You're invoicing out $10,000 every month. So in month 1, however, 0 of those invoices are paid. In month 2, 5 of those invoices have been paid. So your revenue in each month is $10,000. However, the cash received is 0 in month 1 and then $10,000 in month 2. Your cost of goods, I told you up in the assumptions, is 50% of your revenue. So COGS is $5,000 in both month 1 and month 2. You've got another $3,000 of operational costs. So even though each month has a monthly net income of $2,000, the cash flow for month 1 is negative $8,000, and your cumulative cash flow for that month is negative $8,000. And then if you go over to month 2, your cash flow is positive $2,000 because you've gotten $10,000 paid, you've spent $8,000 in COGS, and your cumulative cash flow is negative $6,000. And that's the negative $8,000 from month 1, the positive $2,000 from month 2. So if you're in month 1, you really have to work on threading the needle of paying those expenses before the revenue has come in, and it can get quite dicey. So really strong cash flow forecasting is important, especially in our day and age of where we are right now in this COVID era. And, nobody knows what's going to happen coming into flu season and colder months. And is there going to be a resurgence? Or are we going to go back into shutdown? So I highly recommend, with so much unknowns and so much volatility right now, to really have a strong cash flow forecasting document that you can manipulate on a very detailed level and thread that needle as needed. So one of my favorite formats for this is a weekly, a 13-week rolling forecast. And I really encourage you to, and again, this is a whole other topic that we could go into, but break it down, especially on the AP side, so that you have very clear visibility into what you're paying each week. And so you can like shift and move things as needed, because things change on a daily basis. When cash is tight, you really do need to have that degree of detail to make it work for you. So I mentioned earlier that some companies kind of chase profitability rather than cash flow. And I think that once you get to the point where you're mature enough that cash flow is not such an issue, it's kind of a safe bet. You've got plenty of savings, you know where you're going, there's enough security in your operations, then yes, I agree. It makes a lot of sense to start to pivot to considerations of profitability. But in those early days or any time when cash is constrained, it is, in my opinion, more important to focus on the cash flow aspect, because without cash, you are up a creek in short order. Number 4 in our financial fitness tenets is to evaluate each business center on its own merits. So what I mean by each business center is really each revenue center. So kind of classic example is wholesale, retail, and brew pub. Retail being beer to go, wholesale being what you're selling through a distributor or self-distribution. And then brew pub, of course, is like more of a restaurant environment. And one of the keys here is to organize the chart of accounts and organize your data so that the information is as relevant as possible. So consider, are you going to start to look at your results in terms of classes or divisions? Or if you don't want to go that route of classes and divisions, the other alternative is to have a separate section on your income statement for every business center. So you might imagine, like in this example, there might be 3 revenue centers. So you'd have a section for wholesale sales, a section for retail sales, and a section for brew pub. And then the same thing would mirror in the COGS section as well. And then finally, down in the expenses, you would want to have operating expenses wholesale, operating expenses retail, operating expenses brew pub. And while that suffices, it gets the job done, it also leads to like a very tedious format for your chart of accounts. And it might be more useful to look at things in terms of classes division, where you can turn things on, turn things off, and then the report that's generated is just one business center and not everything. It can make it a little easier to digest and distill information. Another important key for measuring a business center on its own merits has to do with like transfer pricing within your company. So if you have a restaurant and a wholesale operations, if you're sending beer over to the restaurant, your brewery revenue center needs to bill the restaurant for that beer. The restaurant needs to accept that beer coming in and pay an amount for the inventory that is an arm's length, as if it's buying it in any arm's length transaction. So in a QuickBooks world, the way you would do this is you would have a class for beer or brewery, a class for restaurant, and then you're going to create an AR invoice from the brewery to the restaurant. You're going to have a second transaction, which is an AP invoice under the class of restaurant that is for inventory purchase from the brewery. So after those are created, you have an AR invoice and an AP invoice that are both open and they're the same dollar amount. And then you're going to pay both. And you can do this through like a cash on hand account. It doesn't really matter which account is used to pay it because it's going to be an equal in and out, but that will clear the AP, the AR. And then you're going to wash the effects of the duplicate revenue through an administrative class. So this allows you to, when you're looking at your finances, to have the arm's length transaction for the brewery, where the brewery is getting credit to sales to the restaurant. arm's length transaction on the restaurant side, so that the restaurant is getting credit for not only the sales to the end consumer, it's also being charged an appropriate amount for the goods that it's selling to the end consumer, and then the administrative class will wash it out. In the beer world, it's going to be a retail transfer scenario that you use, and you would have contra revenue accounts built into the brewery side and the restaurant side to show the negative effect there. So kind of getting into the weeds on that, and feel free to contact me after this if you have more questions about that. But the purpose of this is that your department heads are going to be judged for the performance of their business center in an arm's length transaction. So the restaurant isn't getting, the restaurant doesn't look like it's doing super well because it's paying nothing for the beer that it's selling. And then the brewery, if you don't do this, the brewery's going to look like it's underperforming because it's not getting credit for all the beer that's being sold to the restaurant. So anyway, if you're holding your department heads responsible for their performance and tying this to the evaluation of their performance, it's critical. And then the last piece is knowing your break-even point. The break-even point can be calculated in dollars or units. So the formula is listed here for both units and sales. And I think this is really important because I find, just in my experience, that human behavior is that it's easier to reach a benchmark if you know how many units you're trying to accomplish, or what is my benchmark sales. And so I know that if I crest that point, that everything else is gravy. I can sleep at night. Also, a huge benefit of this on the wholesale side is in your annual business plans. And not that you're going to plan for break-even units, but if you do your sales forecasting for the next year on a SKU by SKU level, and you break it down into how many units of each SKU that you want each distributor to sell each month, that's going to get you a lot closer to a yes from that distributor than just saying, we want you to increase our sales by 10% next year. So having the discrete data, giving it in terms that's relevant to the audience, in other words, relevant to the distributor, is a key point to success. And then on the finance side, understanding what your break even is helps you know where you can afford to, if you have a certain level and you've reached that level, like I said earlier, the rest is gravy. I guess it means where you can afford to kind of take your foot off the gas a little bit and where you really need to work on getting to the goal line. So also, to take the analysis to the next level, consider the product mix for your company. And this could be as simple as package versus draft. It could be as complex as doing that SKU level break-even analysis. But if you know the relationship between the product, the volume, and the mix of what you're selling, that is going to really help you to make the best financial decisions possible. So this is the book that I wrote, I mentioned earlier, Small Brewery Finance. There really is not a lot out there in terms of financial literacy within the industry. And my personal mission is to help educate the space as much as possible, to give you tools so that you can do your job as efficiently as possible. So you can pick this up at the BA's website or Amazon. And of course, you can contact me directly if you have any questions. I'm going to open it up and see what we've got in terms of chat. Let's see. And if you guys have any questions, go ahead and put them in. Okay, so I had one question about how to get the data on the SKU by SKU level profitability report. And it depends on what system you're using. If you are using orchestrated beer, you can generate a report from the sales analysis tool, and it's going to allow you to dive into the profitability on a SKU by SKU level. You can set your dates. It'll show you the revenue, the cost, the percentage thereof. If you are using Ecos, you can run a similar report for profitability. You'll have to manipulate it with some filters, but generally the data is going to come out of your inventory management software. If you are just running spreadsheets, it is very difficult to get this unless you have very sophisticated spreadsheets. So here's a major plug for getting off of spreadsheets and getting onto a system. I just can't stress it enough. I think it's really important for the integrity of your data to have it in a system. So let's see. Do you guys have any other questions? I don't see any other on the chat board. So let me know if you have any questions. If anything comes to mind afterwards, please go ahead and email me. And I'm going to hang out just for a minute or so. And if nothing else comes in, I will go ahead and end the session. I really appreciate the opportunity to be here. Love the industry, the community, and love to talk further with you also. All right, I haven't seen anything pop up, so I'm going to take off. Thank you guys. I appreciate your time. Be well.